Welcome back to the fundmonitors.com Manager Insight series. Today I'm joined by Alex Lee, Director of Investor Relations at Laureola Advisors. Laureola offer investors the opportunity to invest in life settlements, which is an asset class that is genuinely non-correlated with equities, bonds, real estate or hedge funds. The fund targets a return of 7 to 11% per annum, and over the past 5 years has provided investors with a return of 9.61% per annum. This return has been achieved without major drawdowns. In fact, the fund has only produced a negative return in 2 separate months since inception in May 2013. Alex, thanks for joining me.
Glad to be here.
Alex, ESG continues to be an important investment theme, and Laureola makes an argument that life settlements are a social good. How can a fund that makes a return when policyholders die be a social good?
The answer to that question is you have to think about what happens before the policyholder dies at the point of transaction, right? So just to paint the background, we know that in the US, there is a shortage of retirement savings. It is estimated that about 44% of anyone who is born before 1979 would have a retirement shortfall in terms of savings, right? And once you add in increased healthcare costs, it's estimated about 69% wouldn't be able to maintain their current standard of living, right? And this is made worse by the insurance companies, because the insurance companies would insist on keeping the policies regular so that the policies will still be maintained and active. Right, and that puts an additional cash flow burden on these seniors during a retirement. Now, imagine this: like you're a retiree, you're 60, 70, 80 years old. You are facing increased healthcare costs, lower income, but the insurance company is coming to you every year saying you got to pay your premiums to keep your life policy active. Now, this is not a fair situation to be in. And what life settlement does is it comes in and says, look, we would take some of this financial burden off you, right? We would buy the policy off you, we will give you a fixed cash outlay that you can use towards your life, towards your healthcare expenses at this point in time. The life settlement fund would say, we would pay your premiums going forward. So it takes away that burden of having to pay the premiums every year. And at the end of it, when the policy matures, when the policyholder dies, whatever the death benefit that's paid out under the policy, that comes back to covering the outlay and the premiums that has been paid throughout the whole policyholder's life. And what it does is essentially gives a kind of a better outcome for the policyholder while they are alive, right? There are options for insurance for policyholders to surrender their insurance policies, but under a life settlement transaction, the payout to the policyholder is about 4 times greater. So, all in all, the policyholder gets cash flow while they need it, while they are alive. It's 4 times more than what the insurance company can provide, right? The life settlement funds take up the burden of continuing to pay the premiums and living with the uncertainty of when this policy will mature. And at the end, the life settlement investor gets rewarded for facilitating this transaction, which is a win-win for all parties involved.
Alex, the fund has, as I noted in my introduction, targets a return of between 7 and 11% per annum. The return on the fund has been a little flat for a couple of months now. Are you still on track, do you think, to meet return expectations?
Yeah, the returns profile that we have been experiencing for the last 3 to 4 months, that's actually probably a feature of the fund as opposed to a bug. It's not something that has gone wrong. Now, the 2 perspectives to this. The first one is that, as I've explained in my last answer, one of the uncertainties that the investor would have to take is how long would the person live for? How long would the policy last for? Right? We can calculate expectancies. We can say, oh, we think this person is going to live for another 3 years, so this is going to be like a 3-year policy that we're investing in. But that 3 years is a best guess. It's, it could be 5 months beforehand, it could be 5 months after, 7 months before, 7 months after. We don't really know because we're talking about someone's life. Things that we do not know when someone's going to die, right? So that's something that we do not know. So that's to be expected. We would go through this type of flat performance and then followed by possibly good performance. That's what happened last year. We had some very boring few months, and then some of the returns came in bunches closer to the end of the year. So that's what happened. So that's one perspective. The second perspective that you have to think about for what we do in our fund is how we treat our returns, right? We only count returns. The majority of the returns that we have are realized gains, right? We only count the gains when we actually have the cash into the fund, right? I'll compare that to, say, an equity fund. An equity fund might say they might buy Microsoft for $250, right? And within the month, if Microsoft goes up to $275, the fund hasn't sold it yet. It's just Microsoft is on the books. They will record that as a gain of 10% on Microsoft.
Yeah.
Right. Or for a life settlement fund, because of the nature of life settlements, if we buy a policy for $250 and the market value might be $275 in the following month, we wouldn't record that as a $275 as a $25 gain. We would still record it as $250 because that's not realized. It's an accounting gain. So Laureola chose to be more conservative in terms of how it accounts for returns. Only when the policy is realized, the death benefit is paid out, or we sell the policy and we got actual cash into the fund, will we recognize the gains. So that's why we would have returns that are probably flattish until policies mature, and then we'll have the gains. We wouldn't mark it up. Last year in 2020, 100% of our returns was from realized gains. Throughout the 8 years of Laureola's existence, we average above 80% of all returns as realized gains.
It's an interesting sector, and as you've mentioned in the past, in your last two answers, you're looking at policy maturity dates. How have, with vaccinations happening at a rapid pace globally, and especially in the US, how does that affect life settlements, and how does that affect the fund, do you think, going forward?
One thing we have to realize is that the life settlement industry is not dependent on pandemics to generate returns, right? So the life settlement industry has been operating for many, many years, for decades. And prior to 2020, the returns have been in the teens. That's what the 7 to 11% is based on. So the pandemic adds a bit more to it. So if you look at the statistics in the US, it has been estimated that the pandemic has added about 10% more deaths, excess deaths over what's the long run average. So the average in the US is about 2.7 million deaths in any given year. Last year, the number might be about 3 million plus, right? And so that's an increase of about 10%. In our portfolio for last year, I think one particular policy out of 20 that matured during last year can be attributed to COVID. There might be some others that are attributable to COVID, but on the death certificate, it doesn't say that. So it's just that one. That's 5% out of our entire portfolio, right? So it's probably in the ballpark 5 to 10% additional deaths from that. But if it goes back to normal, if the vaccination allows us to live normal lives again, then we'll fall back to what the average was, and that was what it was pre-pandemic. And just remember, the leading cause of death in the US is heart disease and cancer. Those things haven't really changed, right? And so we still feel comfortable and confident going forward, the fund will still perform on its average.
Alex, thank you for your time today. I think a lot of people don't really grasp the idea of life settlements as an investment. But as I stated at the start, are very, very lowly correlated, if not completely uncorrelated, to most other asset classes in the marketplace. And you guys have got a very strong track record for quite a number of years now. Thanks for joining me, and good luck in the rest of 2021.
Thank you. Thanks for your time.